Gold and silver just did something unprecedented. They didn't just inch past their old price records, they smashed them, leaving a lot of traditional stocks and financial assets in the dust. Gold kept printing new highs, and silver put in one of its strongest years in decades. In the last video, we talked about the two regimes: gold as the confidence hedge, and Bitcoin as the liquidity play. Now we're zooming out to the bigger framework driving gold and silver. But the price itself isn't the whole story. It's a symptom. You'll hear on the news that this is about inflation or a weak dollar. They're not wrong, but they are missing the single biggest macro reason this is happening. While markets deal in probabilities, not certainties, the evidence for this shift is compelling. I'm not here to predict a price. I'm here to give you a dashboard, a framework for understanding the powerful forces at play. Today we're talking about that reason. It signals a fundamental change in the very jobs that gold and silver are hired to do in the global economy. Understanding this framework is vital for your money and for the financial system as we know it. This looks less like a normal cycle and more like a regime shift in how investors are hedging risk. Let's be crystal clear about what just happened. This wasn't a slow, steady climb. This was an explosion. After years of being pushed down and ignored, precious metals have violently reminded everyone that they can act as a powerful measure of value. While the S&P 500 was struggling, gold put in its best performance since 1979. Silver's meteoric rise was its best in decades. So the big question is, why now? And why this magnitude? The easy answers are all there: geopolitical tension, recession fears, central banks getting ready to cut interest rates. But those things have been in the background for years. What's different now is that two powerful forces have finally collided, creating what looks like a perfect storm. One framework to understand this, the model I'm using, is what I call the Great Specialization. This is where you need to watch the plumbing, not the headlines. Our dashboard is simple: real yields, liquidity conditions, credit spreads, inventory trends, lease rates, and the gold to silver ratio. The plumbing shows it: central banks pulling gold off the market, and industry pulling silver out of the supply chain. The market has given two different but equally critical jobs to gold and silver. Gold is taking on the role of the world's ultimate reserve asset for an unstable age, while silver is emerging as the single most essential industrial commodity that also happens to be money. This isn't about one being better than the other. It's about understanding they are now playing two totally different but equally vital roles. And it's the combination of those roles that is sending shockwaves through the entire financial system. Here's the practical takeaway: gold is the confidence hedge. Silver is the torque. The ratio tells you which regime you're in. First, let's talk about gold. The first part of this framework is gold's new job: to act as the world's trusted, neutral anchor in an age where faith in the US dollar is being questioned. For decades, the entire world ran on trust in the dollar and US Treasury bonds. That trust is now fracturing. Just look at the proof. Central banks have been on an unprecedented buying spree, with some reports showing them pulling around 1,000 tons of gold off the market annually for the last few years. This isn't speculators making a quick trade. This signals a coordinated strategic shift. We're talking about nations like China, India, Poland, and Turkey methodically moving their reserves away from the dollar. They aren't just hedging against inflation, they are hedging against political risk and the instability of a global system facing over $315 trillion of debt. When central banks, the biggest long-term investors on the planet, more than double their historic buying pace, it creates a powerful floor under the price. They are taking supply off the market that may not be coming back. And that explains why gold's climb has been so steady and powerful. This is a slow motion tectonic shift. As global debt keeps piling up and faith in paper currencies erodes, gold's role as a store of value is being seen as increasingly critical. This explains why you see analysts at major banks like JP Morgan and Bank of America talking about gold heading towards $5,000 in 2026. They see what the central banks are doing. They get that gold's job is no longer just an inflation hedge. It's being positioned as a core asset for what might be the next era of global finance. Now we get to silver, and this is where the dynamics get even more complex. If gold is the anchor of stability, silver is positioned as the engine for high-powered growth. And its engine is firing on two cylinders: its critical industrial role and its classic monetary role. For years, people have warned about a coming silver supply deficit. Well, market data shows that deficit isn't a future projection anymore. It is here. 2025 was the fifth year in a row where analysis concluded the world used more silver than it mined, and the gap is getting bigger. Why? Because silver is the lifeblood of our future. Think about it. Over 60% of all silver demand now comes from industries that are the backbone of the 21st century. Solar panels, electric vehicles, 5G networks, AI data centers. Finding effective substitutes for silver's unique properties is incredibly difficult. It's incredibly challenging to build a green, high-tech world at scale without it. This demand doesn't just go away in a recession. It is structural. Factories will pay what it takes to keep their lines running. This is creating a physical squeeze of historic proportions. We're seeing reports of inventories in major hubs like London and China being drained to dangerously low levels. This intense industrial demand is colliding with silver's other job, being money. As investors see gold surging, they rush into silver looking for a bigger, more volatile move. This explains why that old gold to silver ratio, which was sitting at a high of 80-1, has been compressing so violently, dropping down into the 50s as money floods into the much smaller, much tighter silver market. This helps explain why silver's price move can be so much more explosive than gold's. It gets the same tailwind from the monetary fears driving gold, but with the massive accelerant of what looks like a brutal physical supply squeeze. The focus is shifting from a paper game to a scramble for real physical metal. This is what's behind the bullish bank forecasts. They understand the market is finally realizing silver is being treated as a strategic asset with few viable replacements. So, why is this great specialization framework a macro reason to grasp right now? Because it signals what may be a permanent change in how wealth will be protected and built over the next decade. We are entering an era defined by currency debasement and a scramble for real, tangible assets. So here's the dashboard, the key metrics to watch. First, the gold to silver ratio. Second, real yields. Third, liquidity, which we track through the Fed's balance sheet and credit spreads. Fourth, physical inventories at the LBMA and COMEX. And fifth, lease rates. These metrics give us a clear view of the underlying stress and opportunity in the market. This framework also gives us a clear sequence of events. First, gold leads the way, confirming the big picture monetary trend and protecting capital. Then, once the trend is locked in, silver follows, but with much more velocity, delivering outsized performance. Looking at only one, without considering the role of the other, means you're only seeing half the picture. This isn't about day trading. This is about recognizing that the very definition of a safe asset is changing right before our eyes. The record-breaking prices are simply the market waking up to the new jobs that gold and silver now have. Ignoring these signals presents a significant risk to your future purchasing power. So let's put it all together. One framework for understanding the historic price surges in gold and silver is what we've called the Great Specialization. In this model, gold is cementing its role as the world's neutral and trusted reserve asset as the dollar's dominance is questioned. And silver is emerging as a mission-critical industrial commodity facing a structural supply crisis, all while keeping its identity as a monetary metal. Together, their price action is a clear sign the world is fundamentally repricing hard assets in an economy saturated with debt. The forces we've discussed are structural and long-term. Central banks will continue buying gold for stability. The world will demand more silver to build the future, and there simply may not be enough of it. The game is changing, and the old rules no longer apply. And those who understand the new jobs of gold and silver will be in a better position to protect and grow their wealth in the years ahead. And here's the punchline. Gold is the confidence hedge. Silver is the torque. And the ratio tells you which regime you're in. In the next video, we're going to zoom into silver specifically. The deficit, the inventory drawdowns, lease rates, and the exact dashboard signals that tell you whether this is a real physical squeeze or just a temporary narrative.